Well, g'day there everybody. Thanks a lot for joining me once again. I just wanted to say from the outset of this video that this isn't meant to upset anyone whatsoever. It's not meant to frustrate anyone or to, so to speak, trigger anybody whatsoever. This is just going to be a simple breakdown of what's going on in the world of commodities, namely gold and silver. The reason for this video is because today I was reading an article just put out where Goldman Sachs more or less has just turned publicly bullish. I mean, overwhelmingly bullish for the future of gold and silver. And again, notwithstanding your own personal sort of fundamental belief in commodities and obviously, I guess, the preservation of purchasing power in the face of a lot of quantitative easing and the current historically low, interest rates going on. And the reason, of course, as to why gold and silver, at least commodities or the commodities complex, is so important to a lot of people around the world. I know this actual subject in and of itself is relatively emotional for a lot of people, or at least it's heavily driven by emotion. I just wanted to give you my very frank outlook on these particular markets, or at least these particular commodities, and what to look out for moving forward. The reason for this is because there seems to be, again, a major disconnect as to what is going on, I guess, out there in the public sort of realm of readable sort of content as to what is best for people to actually follow or what to actually look out for. In the world of technical analysis, it is relatively straightforward as to when we can obviously see opportunity and when to act on it. And very simply, in the world of GLD, I need to bring this to your attention because, again, it is the simple truth. It is the honest truth. It is, again, just glaring at us in the face. And until certain things change, we have to, of course, remain relatively bearish at this particular point for one simple reason. And that reason, okay, now again, just to try and look at this, or at least try to detach yourself emotionally if you find yourself extremely bullish, even short term on this particular chart at the moment, is the simple fact that since 2011, gold has been continuing the evidence of putting in lower highs, relatively speaking. I mean, if we look at this chart, I mean, from 2011 all the way through to late 2012, this was on the third occasion where we got the third sort of back test of what was assumed to be a bearish sort of trend line, which was establishing itself. Now, what we've done is we've obviously connected these three peaks, or at least three consecutive lower highs, and we've extended the actual line out into the future. Now, bringing the chart or graphing the chart most recently through to about mid-2016, we saw gold, or at least very, very early on in 2016, gold and silver, they went more or less parabolic. They went absolutely ballistic, more or less, to the upside. It wasn't a surprise, however, to see the handbrake, so to speak, pulled on this particular commodity right around, once again, that declining bearish trend line since 2011. Now, for a number of months, we sort of, stagnated back and forth until ultimately we broke below this 124 level. And since then, we came down to about 110. We've rallied, again, very similar to how we began the year in 2016. This has continued into the beginning of 2017. And then if we look at this at the current juncture, on two occasions in the year 2017, we've come up into this declining bearish trend line. And then again, on a secondary attempt, most recently, only 4 weeks ago, or going back to essentially May. If I zoom in onto the detail, you can see this is the daily chart of gold. Now, a lot of people have been sort of, really talking up the prospects of gold, but it is really this simple. If I can sort of condense this down into one sentence, if not a couple of paragraphs, a couple of sentences or one or two paragraphs, it really is this simple. It's not in your best interest to really be bullish, or at least aggressively short-term orientated bullish on gold until it breaks above this swing high over here, or until we can break above this declining bearish trend line. The reason why, again, this is factually speaking, going back to 2011, is that every time we have rallied back up into this declining trend line, we have failed. The price of gold has tagged it, and it has such sold off. I mean, most recently over the past 3 months, April, we hit it, we sold off, okay? We rallied early to mid-May. Where did we stop? At the declining bearish trend line. What happened in the process of selling off? And again, according to Dow theory, which is a very important tenet, or one of the, Dow theory itself, one of the tenets of this is that a trend is assumed to be in effect until it has given us definitive signals that it has reversed. Essentially what that means, right, in layman's terms, is that, look, the bearish trend, which we are clearly in, as per the 2011 bearish trend line that you can see on my screen, again, the extension of it in red since the most recent peak, or going back to at least April 2007, is still in effect. So let me ask you the question, what would we assume, or what would sort of give us the confirmation that the trend itself has reversed from that of a macro bearish trend to that of an immediately type of bullish sort of favorable scenario for us, both on a molecular level, an intermediate level, and a macro level? And again, I'll just draw a question mark on my screen, sort of a rhetorical question. Obviously I can't hear a response, but I'll just count down 3, 2, 1. And the answer to this, of course, is that 1, okay? Dot point number 1, we need to break the declining bearish trend line. Very straightforward, very simple. It isn't a trick question. It's just, you know, the nature of it is just so straightforward. It really shouldn't be fooling anyone. Number 2 is that not only do we need to clear this bearish trend line, but we need to hold above or break above the swing high, which we have that we have priced in at early June 2017 and also mid-April 2017. So you can imagine sort of a horizontal sort of resistance line, as you can see on my screen. Again, a rather sort of ugly type of horizontal line that I'm drawing on my screen, but really they are the 2 dot points. And if you can imagine the space, I mean, if we're talking about angles here, it looks like a little bit of an acute angle, but all of this red space right in this vicinity here is what we call the danger zone. And in the past, we've even identified the danger zone, and it has, kept us out of the top and what was, an exhaustion gap over here at the beginning of June and subsequently since the actual bearish reversal. Now, again, we're actually in this bearish on gold for the majority, or at least over the past maybe 4 months or so. We have had a lot of fantastic bearish opportunities and trade setups on gold, although I have deleted the majority of them. I mean, if I just bring up the chart of silver at the moment, you can see for yourself since February 2017, we have had 4 trades, okay, on silver. So in the space of, February through to more or less the end of June, we have had more or less 1 trade per month. All of these trades have worked out. On the upside, I mean, although it was dotted, I stayed out of this personally because, again, I don't like to trade counter trend, so to speak. We've had a shortable opportunity at 1646 down to support. We've had a secondary shortable opportunity at 1673. We hit our first target here, a second target down here. I've deleted these orange targets. What I do is I drag them over. So as you can see on my screen right now, I've got an immediate target right now at 1533. And here we are at the moment in at 1592. This is a trade we got into a number of weeks ago. And although we saw a little bit of a bounce, this is just market noise. It looks as though we're in the process of continuing down to 1533, and then if that level cracks down to 1490. So I mean, of those 4 trades, 3 have been bearish, 1 have been bullish, and it fits the profile of that broader sort of decline which has been going on, if not sort of a stagnation. Because if I bring up the chart of gold, and again, I've been looking at this chart so much, it's sort of ingrained into my subconscious at the moment. If I just go to a closing line chart, you can see that since 2013, more or less we've been moving sideways, and again, another sort of rectangular pattern. Although we have been in that of a bearish trend and sort of like a intermediate bullish bounce, more or less we've just been moving sideways. So it looks as though potentially that long-term macro bearish trend is coming to an end, and maybe that's, Goldman Sachs didn't specify its actual time frame on their sort of outlook. But I mean, again, very simply in layman's terms, until we start to see one of those 2 points taken out, but we really need to see 2. One being, of course, the breaking of that downward trend line. And I mean, that's number 1. And number 2 is, of course, getting above both the June swing high and its relevant, or at least it's, the similar swing high in April 2017. You have to be very cautious if you're looking to swing trade this, okay, for bullish opportunity, because at the moment it looks as though we are starting the process of actually rolling over. Now, although we are short-term oversold, on the weekly chart, you can see for yourself, we've almost scribed in a little bit of a double top. And ask yourself the question on the weekly time frame, are we overbought, are we oversold? And the answer to that is, look, we're very neutral and we can break very easily one of 2 directions, but we have been overbought recently, and it looks as though we're trying to push on back down more so into oversold territory. This is on the weekly time frame, which is going to take a couple of months to actually do that. So I mean, it looks as though we have a lot of opportunity to run lower if in fact gold and silver choose to do that. I haven't actually broken down sort of that inverse relationship between gold, silver, and the purchasing power of the US dollar. But at the moment anyway, I'm not sure if I said this, we are in bearish in gold at the moment. Our original entry was 119.27. We had a secondary entry at 118.91. We had a short-term bounce, but it looks as though the difference between Friday and Monday is just the continuation of our original sort of directional outlook for our first target at 116.44. And then ultimately, if this level breaks over here in early to mid-May, 115 is a secondary entry, which is going to take us further down. I mean, quite considerably lower if we choose to do so, if the price action of gold chooses to do so. So again, that's the reason for this particular video, is just to sort of cut through the nonsense and just to give it to you as really you should be hearing, or as you should hear. If you allow yourself to interpret what it is I've just said, I want to encourage you to sort of re-listen to this if you find yourself sort of scratching your head as to what I've just spoken about, or maybe I went through it a little bit too quickly. But again, it is just common sense, okay? Just ask yourself really maybe 1, if not 2 questions. How many times has gold broken above its declining bearish trend line? And the answer to that is 0. Ask yourself a secondary question. If you've bought anywhere near this bearish declining trend line, has it been profitable? The answer to that question is also 0. So you can see why I'm sort of staying away from it as if it is, or acting as though gold and silver are radioactive at the moment. Again, depending on your time frame, and again, fractal outlook, it may be one of the most undervalued sort of, financial assets out there, tradable in the world of financial markets. I mean, can't really remember the last time gold was printing around these lows. You have to go back a very, very long time ago. And again, on a long-term sort of outlook, again, depending on if we're moving into sort of a period of inflationary pressure or deflationary pressure, which is what it looks as though central banks are trying to sort of starve off at the moment. Price action is obviously going to rise exponentially for gold and silver, or it's actually going to collapse further, which is going to shock a lot of people moving forward. But all we can do in the world of technical analysis is say price action is king, and just move with it as the chart changes, and obviously will change with that price action. So I hope this has been beneficial for you. If you want more analysis on this, I would encourage you to have a look at Pro. If not, I'll be back later in the week, and I look forward to bringing you some more pertinent market updates. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Goodbye.